Hi, Steve Walker here from Promise Money. You might have seen my recent video about the pricing of development finance and how you can get the rates cheap. Today I want to just go into a little bit more detail about preparing yourself for development finance and just talk about what lenders are looking for and the sort of things they think about, which might help you to position yourself in the best possible way when it comes to development finance. So first of all, let's just talk about the whole risk versus reward for lenders. They're always going to look at the risk and they're going to look at the reward. And some lenders, mainly the bank lenders, are more risk averse, and then you've got the specialist lenders who have more appetite to take a risk. But with that comes an increase in price. So the higher you go up the risk curve, it's more likely that you'll pay a higher rate for it. And that's fundamentally what it is. And eventually you'll get to the point where the risk will be so high that every lender is going to say, no, we're not going to do it. So let's talk about what they see as risks and the questions that they're going to ask. Just to step back a second from that, however, what is development? Well, it falls into a number of different camps. You've got your small development loans, which are anything up to, I suppose, £1 million is seen as being a small development loan, and different lenders play in different markets. So you've got a section of lenders that play in that market, and they tend to be the lenders who are more bridging lenders who've moved into development. And they tend to pick up the smaller developments, and they will tend to charge more, but they're probably going to be a little bit more flexible. And there's a whole range of products around that sector. Then you've got the from $1 million to $5 million, which tends to be the larger developments, and it's $1 million plus. I'm really going to be talking more about today, really. And then you've got the large developments, which is $5 million up to $50 million, and what they're going to be looking for. Obviously, different lenders will look for different things, but a key thing is they want to be in at the beginning. So if you've got a development and you're pulling a development lender in halfway and saying, right, I want you to help me to finish this off, their answer is going to be quite simple. This is a failed development because you should have thought this through the whole way. So why haven't you got the money to finish it off yourself? And as soon as you're in that position, then a lot of lenders are going to disappear. They're not going to be interested because they don't want to finish off somebody else's work. They want to be in at the beginning. They want to see what's been done and sign it off at each stage, especially if it's a larger development. So it doesn't mean that you've got to use the developer's funding from the outset, but you need to have them in the game. You've got to present this as if this is a development you've thought the whole way through. So if you're sitting on a big chunk of cash, and you might just be able to do it with your own cash, then that's fine, but get a development lender engaged and signed up at the outset for what you might need towards the end. If you don't need it, that's fine, but they want to be in at the beginning. They don't like failed developments. They don't like developments where your existing builder has walked off site because he couldn't do everything at the cost he said he was going to be, or you've had a tiff or whatever it might be. They don't like that sort of thing. Obviously, for it to be developed, it's got to have planning. So make sure you've got all your planning sorted, and there's lots of due diligence that you need to have done to be able to present this in the best way to your lender. If you've got a bit of an idea and you're looking for £1 million upwards, and you're asking somebody like me to go out and get you terms, you're going to get something back pretty fuzzy. I would say worthless, because they want to see that the due diligence has been done on the build and what's so they understand the build, the people who are doing it, etc., etc. And the other thing is that some lenders will do conversions and others will do ground up. So if you're looking at ground up, that's a different set of lenders to potentially conversions from commercial to resi. That is different. That's almost not really development, and there's a different set of lenders available to that who've got some really great terms, but it's different to ground up development. So let's assume we're talking about a ground up development. So they're going to look at the property. What's the complexity of the build? Is it straightforward, or are you having to reroute rivers and do all sorts of things which require specialist input? If so, you need to have that specialist input before you go to a lender, because that's the first thing they're going to ask you. How are you going to do all this? They're going to look at the planning, they're going to look at what's involved. What's the type of property? Is it a commercial development or is it residential? Lenders prefer residential because the exit is easier. If you're going to build a residential block of flats, then they know there's a ready demand for those flats. You might be selling leaseholds, you might be letting them, you might be exiting onto a deal where you retain it as a multi-unit block. But they know that the exits are easier. If it's commercial, then they're more likely to get you onto the best rates to say, well, have you got a pre-let agreement? So if you're building a commercial property from ground up, well, who's going to own it and who's going to rent it? So think about those sorts of things. That's all important. Next factor is the what ifs. They're going to be thinking, right, what if the builder decides to walk off site halfway through for whatever reason? And that means they're going to be looking at the experience. They're going to be looking at how they're going to get out of the deal. Are they going to sell it, or are they going to continue to develop it on? Hence why they need to know what's happened up until that point, because if they don't, they've got to develop it on to an exit because the developer has failed. And to be fair, because you have failed in your whole plans. Let's say they have to repossess it, and that's what they're looking at the end of the day. The developer has failed, they've got to take over, and they've got to get their money back, they've got to develop it on to get it finished. So who did the work beforehand? What was the quality of the work? What's the quality of the builder? So those are the sorts of things that they're going through their head. So let's get into some specifics. They're going to lend against the day one loan to value. They're going to lend against the GDV, what it's going to be worth at the end, and they're going to be lending against the costs. So you need to have those figures, and they need to be well worked out. So if you haven't got a schedule of costs and works of what you're going to build, you need to get one, because that's the first thing they're going to ask to see. And then they're going to go through that with a fine-tooth comb, and they're going to look at what you've built in for contingencies. They're going to look to see that the costs are accurate, and they're going to speak to their surveyor and say, right, this is the build, what do you think it's going to cost? And if your costs are down here and the surveyor's saying the costs are up here, they're going to ask you why is there a difference. Now, there could be a difference. You might be doing a deal with your builder where he's taking a share of the profit rather than adding his 20% or whatever that might be onto the costs as he goes along. So we need to understand that. There could be something in the build where you've managed to save some costs because of the construction that's there at the moment. So we need to understand that. So all of that information has got to come out and be given to people like me. Otherwise, we're really going into a fight with an arm behind our back because we don't know everything. So our job is to present everything as thoroughly as we possibly can, so it shows it's properly thought out, so that lenders look at it and say, yes, I understand it, yes, I buy into it, I can see what you're doing, I buy into you, and I buy into your build, and I buy into your costs. So we know what the GDV is, we know what the day one value is. They will lend you a percentage of the day one valuation, they will lend you a percentage of the GDV, and they'll lend you a percentage of the costs. And what those percentages are, I'm not going to get into that, but you're probably fairly familiar with them. But that's going to dictate which lender's going to play and what rate they're going to be offering you. And then the other things they need to know is, well, how much are you going to be requiring at day one, and what are your drawdowns going to be? And that's going to determine the amount of interest, because that's got to be factored into the whole deal as well, because they of course will lend you the gross amount less interest and fees to leave you the net amount that you need. So let's talk now about experience, because this is absolutely fundamental, especially on bigger developments. If you're refurbing a buy-to-let property or maybe doing a small conversion, you can get away with less experience. And to be fair, if you're looking to, I don't know, build a £3 million block of flats and you haven't got experience in that sector but your builder has, there are still lenders who will take a look at it, but come back to what their concern is. What happens if the builder walks off site? So if you don't have the experience, then they're going to be looking to that builder and say, right, well, what's his skin in the game? If it all goes horribly wrong, can we come after him? Will he sign personal guarantees? So if your experience is low, how big is the step up you're taking now? If it's a big step up, they're going to ask questions. If it's a big step up for the builder, they're going to ask questions, because they want to know that the people who are doing this, that they're relying on to go from start to completion, have done this sort of thing before. So how do you mitigate that? Personal guarantees will certainly help. So if you're sitting on a load of assets, that is going to help. If you're not sitting a load of assets and this is all you've got, then generally speaking, lenders are going to say, well, no, we're not prepared to take a punt on that, because if it all goes wrong, we've lost our money. So who's going to be putting up the personal guarantees? Is it you? Is it the builder? Is it both of you? And what's the value of those personal guarantees? If the builder puts up a personal guarantee but he's got no assets, it's worthless. So what's the value of those personal guarantees? Who's going to be building it? Who's going to be managing it? Who's the developer? You? What's their skin in the game? And what is the contract that's tying all this together? So you need a really strong contract with your builder. So assets, experience, and a decent contract. Really, really important. So once the lender knows about you, about your builder, about the costs, that his surveyors confirm those costs are reasonable, knows about the site, because obviously location is important as well. Some lenders will only work south of Manchester, some just around London, others will cover the whole country. Once they've got a handle of that and they understand what's their contingency if the builder walks away or if it fails, then they're in a position where potentially they'll meet you on site. They'll want the indicative cost, a site visit, and then there you go, they'll meet you on site, and that's when you start to thrash out the details. Now, getting to that point is not a quick summary email, here's what we're looking to do. It's a bit more than that. It's a little bit more than that. In fact, it's a lot more than that, really, if you want to be demanding the best rates. If you just want to provide a very high level summary, then we can find lenders who will meet you on site and talk to you about it. But you're going to be fishing in a different pond rather than the ones where the banks are operating and are offering some really, really good rates. And there are some good rates around there. So to summarise, I would say, don't hurry into this. Don't expect to get terms straight away, because you won't get the best terms, or you won't get terms that stack up. You know, we can give you some really great terms based on ifs and buts, but really lenders want to bottom out those ifs and buts and understand what they are. So put together a professional and complete proposal, which includes CVs of your builder, your contractor, of yourself, works that you've done in the past, and demonstrates that this isn't a step up for you. Include the planning, include the plans for the building. If you've got structural engineers reports, include that. Include as much as you possibly can so that we answer all the questions for the lenders. If you can't get hold of that information, it's not the end of the world. It means we've got to reel lenders in more slowly, but you can't really rely on the numbers that they're going to give you, because they can't rely on the information that they've given you. So they're always going to have the get out clauses. So the more you get at the outset, the better. Let's get it into a number of lenders, get the best possible terms, bang, get a meeting on site so that you can get to know them, they can get to know you, and you get confidence in them and they get confidence in you. I hope that's helpful. There's nothing in there which is rocket science. It's just about, if you are going to portray yourself as a professional developer, you need to look like one, you need to act like one, you need to provide information like one, and then you're going to get the best possible terms. Thanks a lot for watching, and talk to you again soon. Thanks, bye-bye.